With the Republicans winning the House of Representatives, the first test of this divided government, well, it's likely to be addressing the debt ceiling. Now, every time this happens, the media goes nuts and they like to do their fear campaign. And we're going to have to expect that for the next couple of months. Now, quite frankly, this kind of feels like deja vu all over again, though, doesn't it? If that's how you're feeling, you're not alone. You see, debt ceiling drama emerges from the depths of political ineptitude with sad regularity. So I want to explain what's going on and why the financial Armageddon hinted at by the talking heads on TV probably won't happen. First, let's talk about how does it all work and why does this happen? Congress tells the Treasury to cut checks to entities it has promised to pay and to collect taxes. Now, the amount of money Congress promised to pay often exceeds the amount it collects through taxes. We've seen this time and time again, and the Treasury then has to borrow money to cover the difference. Now, the United States debt ceiling is a legislative restriction on the amount of national debt that can be issued to meet existing legal obligations. Now, when that ceiling's reached, the Treasury's got to find a way or other ways to pay expenses, or they have to ask Congress to simply raise the debt ceiling so it can be issuing more debt. Now, if we don't do this, our country could default on its existing obligations. Now, here's the thing. Since the end of World War II, Congress and the president have modified the debt ceiling, wait for it, almost 100 times. Now, each time the national debt reaches the debt ceiling subsequently rises. Now, this drives home a pretty critical point in my opinion. The debt ceiling, it's pretty useless. It's never once forced Congress into any realm of financial discipline, and it really doesn't restrict future spending. All it does is restrain the Treasury from paying expenses that have already been incurred. In other words, the government may not be allowed to borrow more money, but it can continue to increase its future liabilities. So the debt ceiling, it's little more than a political tool for Democrats and Republicans to yell at each other until the 11th hour and get everybody kind of nervous. Then brinksmanship once again yields to a miraculous compromise that enables the government to avert a self-induced catastrophe. We've seen it before, haven't we? Now, what options remain? Well, if the Democrats did retain control of Congress, they could have voted to raise the debt ceiling through a process, it's a budgetary process called reconciliation. But since the Republicans split Congress, this option is off the table. The Democrats instead need to rally the support of the Republicans to raise it higher, which should happen since it happens all the time. Now, a more aggressive option is just to ignore the debt ceiling. Now, those who study constitutional law, they often point to this clause in the 14th Amendment, which states, "The validity of the public debt of the United States, authorized by law, including debts incurred for payment of pensions and bounties for services in suppressing insurrection or rebellion, shall not be questioned." Again, shall not be questioned. So some would argue that this would authorize or even require Biden to act to avoid a default. For example, he could instruct Treasury Secretary Janet Yellen to simply ignore the debt ceiling, but this option would probably end up in court, much like the college debt situation is right now. Now, another option, and this is going to sound like a joke, but the Treasury could issue a platinum coin with a face value of, let's say, $1 or $2 trillion, and then deposit that into the Treasury's account at the Federal Reserve. The law that governs the types of coins the Treasury Department is legally allowed to mint includes a special clause, and it says that the Secretary may mint and issue platinum bullion coins and proof platinum coins in accordance with such specifications, designs, varieties, quantities, denominations, and inscriptions as the Secretary, in the Secretary's discretion, may prescribe from time to time. Now, this law, it appears to give Yellen the power to determine the face value of a platinum coin, mint it, deposit it, and simply go back to paying bills. However, using the same law that empowers the Treasury to mint special commemorative and collector's coins to avoid defaulting on national debt, well, it carries, I guess, what we'd call a near unquantifiable amount of ridicule. So, what's the bottom line? Well, what if Congress just doesn't act this time and the U.S. does default? Now, it's never happened before, and while the future is unclear, three outcomes are likely. First, the U.S. would no longer be viewed as risk-free. Now, nearly all of finance and investing is predicated on assessing risk, but risk is relative. Now, the starting point is the risk-free rate, which is the interest rate on an investment that has no risk. Now, if the U.S. is no longer the de facto option for risk-free, the world would need to seek out another risk-free rate or adopt a new strategy to assess risk. But I also don't see this being necessarily cataclysmic, right? Sure, the U.S. would no longer be risk-free, but it's not because we couldn't issue more debt. If we defaulted, it would be because we simply chose not to pay. It's kind of like a billionaire failing to pay a credit card bill. At the end of the day, late fees, they probably will get charged, but it's not like the card holder is going to go hungry. Furthermore, foreign debt holders might be upset, but what are they going to really do about it? As of 2019, more than 88% of foreign exchange trading involves the dollar, and nearly all commodities are priced in dollars. So why is this important? Well, this dominates as the payment currency for global trade with 79.5% share of currency usage in value. What that means? Well, if a company, let's say in Malaysia, wants to buy oil from Saudi Arabia, that transaction, it's completed using dollars. And if you're going to rewrite these contracts and redirect so much international trade, this is going to take time and equal trust in a replacement currency. Now, the US dollar also represents 59% of all known central bank foreign exchange reserves. Now, the next closest one is the euro, which is 21%. So that means there's nowhere near enough euro in circulation, let alone any other currency to replace the total value of dollars held. Now, the second thing to consider, the impact on the economy would likely be low if we defaulted. You see, almost 70% of U.S. economic activity comes from consumer spending. So the economy is growing when we go out to dinner or get our hair cut or go to a car wash. And in business, if we add in business spending, those two together represent 88% of the $21 trillion economy. Therefore, the only conceivable way that a national debt default could trigger Armageddon is if it were to cause consumers and businesses to pull back spending in a major way. So I want to be clear, there would be an impact. This isn't something that has no impact, but depending on how the Treasury prioritizes who gets paid first, some people would likely go without a paycheck or Social Security for a couple of days or weeks or longer. Now, borrowing costs, they may rise to the point where some consumers balk and they begin to postpone purchases. But to use words like catastrophic or Armageddon, it's a bit reckless. And that's even for politicians and the media to use words like that. It's a bit reckless. Now, the third thing that we have to consider is the world would not end. Let's rewind the clock a couple of decades. And who could have envisioned the outcome of central bankers implementing interest rate policies that are negative, or a global economic shutdown to slow a pandemic, or Brexit, or negative oil prices, or the worst attack on U.S. soil since Pearl Harbor? When we take a look at all of these, each of these events, they've challenged traditional norms of finance and economics. But none of them, and there were some major ones in that list that I just gave you, none of them caused the world to end. Sure, things changed. And financial physics may not feel the same as before, but we've adapted because we didn't have a choice. Now, there's really no apparent reason why this time would be any different. Lastly, another unthinkable event occurred back on August 5th of 2011. Now, this was when another debt ceiling battle led to the first ever downgrade in the U.S. sovereign credit rating. Before then, the U.S. had a perfect AAA rating, and the uncertainty around what would happen next was at peak levels. Now, at first, people were scared. When U.S. got downgraded, the S&P actually fell over 17% in just days surrounding this downgrade. But as those who anticipated the worst began to realize that the Earth was still circling the sun, the index recovered within 6 months. Now, since then, since the downgrade, the S&P 500, it's quadrupled. The bottom line is that neither party really wants to be blamed for causing the first default in U.S. history. It's just not on their agenda. So this mess, it's likely to be resolved. If not, think about the aftermath of all of the other unthinkable events before you panic too much, that is. Now, if you have any questions or you need some answers, just send us an email at hello@hobartwealth.com. As you know, we're always here to give you our insight and our financial commentary with whatever your questions may be. Thanks for tuning in. We'll see you next week.